Before we go into the first area of our calculation, in respect of our foundation learning, it will be important for us to know what is a ledger, since most of the transactions and recordings will take place inside the ledger. A ledger is a book in which classified and summarized accounting transactions are recorded. Usually, ledgers have opening balances and closing balances. The ledgers are usually divided into parts: the debit side and the credit side. Let's take a look at what the ledger looks like. Before we go into the first area of our calculation in respect of the double entry principles, it will be important for us to know what is a ledger, since most of the entries and calculations will be done inside the ledger. What is a ledger? A ledger is a book in which classified and summarized accounting transactions are recorded. Ledgers usually have opening balances and closing balances. Ledgers are divided into parts, usually the debit side and the credit side. Let's take a look at what the ledger looks like. Now, looking at the ruling of the ledger, you can see it is divided into two parts with double line. You can also use a quoted line to divide it. The left side is called the debit, abbreviated DR. While from here to here, the right side is called the credit, abbreviated CR. We have the rulings: date, particulars, folio, amount. You repeat again: date, particulars, folio, amount. The same heading at the left side is the same at the right side. Now, we now rule to form each segment. And as you can see, we have the date, particulars, folio, amount at the debit side, and date, particulars, folio, amount at the credit side. The date represents where we write the date the transaction is taking place. For instance, we have 2021, January 1st, there was sales of 1,000 naira. So the particulars represents the transaction taking place, while the amount is where we write the amount involved in the transaction. The folio is for reference purposes, and the folio number is a number that is used in accounting to identify an entry in the journal or ledger. With this number that is here, you can easily trace this transaction to the book of original entry. That is the first place that the sales was recorded before it was transferred to the ledger. So the folio is for reference purposes. At the credit side, the date represents also the date of the business, 2021, January 6th. And under the particulars, the transaction is written there, purchases. And we have the folio and the folio number, which is 03, and the amount involved in the purchases, which is $800. This same ledger can also be presented in this way. You can still see 2021, January 1st, sales $1,000. We have 2001, January 6th, purchases $800. The same as the right side is here, and the same as the left hand is here. Now, the only difference is that while this ledger is detailed, the headings are detailed, this one is not detailed. But in most cases, under examination condition, it is this type that is used, just in form of a cross. Now, this ledger can also be used for any account. For instance, you can see a ledger here, and on top is written motor vehicle account. If we are recording any transaction in respect of motor vehicle, it is motor vehicle that will be written on top of the ledger as the account in question. Assuming we are trying to record rents that has been paid within the period, what we are going to write on top of here is rent account. Assuming we are paying salary, what we write on top of here is salary account. So the ledger can represent any account, as the ledger can also be called account. Now, having known what is a ledger, how many types of ledgers do we have? Since we said that ledgers are accounts, which can be called ledger accounts, how do we know various forms of ledgers that we have? To be precise, ledgers can be of three types. We have the receivable ledgers, which represents ledgers or accounts opened for those that has contractual relationship with our business. Those that are owing us, those we sold goods to that has not paid. Then we also have the payable ledgers or payables account, which can also be called account payable. Now, this ledgers account represents accounts of people that we also have contractual relationship with. They represent suppliers that supplied us goods that we have not paid, or people we are owing. It is a liability account or ledger. Apart from receivable ledgers and the payable ledgers, all other ledgers comes under what we call general ledgers. How do we now know which is receivable ledgers, which is payable ledgers, which is general ledgers, and how they are applicable in accounting recording? This will bring us to looking at types of accounts. We have 6 types of accounts that I want to lay emphasis on in respect of our foundation knowledge. These 6 accounts can be divided into 3 parts. We have the equity account, which can also be called the capital account. We have the personal account and also the impersonal account. The equity account represents accounts of the owner of the business. The account that shows how much the owner of the business has invested in a business. When we talk about personal accounts, we are talking about accounts that represents persons. Persons or organization that our business has contractual relationship with. Such personal accounts may be accounts of receivable or payables, as we have just explained. Then we have the impersonal account. The impersonal account are accounts that does not represent persons. The impersonal account can further be divided into 2 parts: the real account and the nominal account. When we mention real account, we mean accounts of tangible assets, accounts of properties like land and buildings, plant and machineries, furniture and fittings, equipments, motor vehicles, and so on. They represent accounts of those things that we can really touch. They also represent intangible assets. Assets that cannot be what? Touched or seen. We also have the nominal account under impersonal accounts. The nominal accounts represents accounts of items of income and expenditures. Every business usually incur expenses such as rent, payment of salaries, payment for stationaries, and so on. When these expenses are made, they fall under nominal account as expenses account. The nominal accounts also includes accounts of income. For instance, sales. When we sell goods, they represent income. Also, things like commission received are also income. These accounts falls under nominal accounts. So we have said that the nominal accounts are divided into two. It's the expenses side and the income side. So when we calculate the numbers of accounts that we have mentioned now, we have mentioned the expenses account, the income account, we have mentioned the equity accounts, we have mentioned the asset accounts under the real account. Let's take a look at a diagram that will give more explanation to these 6 types of accounts I have just mentioned. Now we talked about 3 types of ledgers. We said accounts receivable ledgers, which are accounts of debtors, people we sold goods to, or people that are still owing us. Then we have account payable ledgers, which represents the ledgers or accounts of those that supplied us goods that we have not paid. We are still owing them, so they are called payables ledgers or payables account. It represents liabilities account. They also have the general ledgers, which are many. So any ledger that does not fall within the realm of account receivable ledgers and account payable ledgers falls under general ledger. So to further explain this, we said we are going to use 6 types of accounts to illustrate more about the ledgers. In these 6 types of accounts, we divided it into 3 parts. We have the equity or capital account, which represents the account of the owners of the business. It is this account that shows how much they invested in the business or how much they reinvested in the business. Then we have personal accounts. Under these personal accounts, we talked about 2 types of accounts: the account receivable and account payable. So whenever a name of a person is written in account, it's either such person or such organizations are people that are owing us or people we are owing. Account receivable represents those that we sold goods to that has not paid. So under the impersonal account, we have the real account and the nominal account. When we talk about real account, we are talking about accounts of things that are tangible. Things like tangible assets. Example of a tangible asset is plant and machines of an organization, furniture and fittings, equipments, and so on. When we open an account in respect of these tangible assets, they fall under real account, which stems from impersonal account. Then another area of impersonal account is what we call the nominal account. This nominal account represents either income or expenses items. So when we talk about the nominal account, we are talking about accounts that represent items of income and expenditure. An example of income is sales. An example of expenses is rent. If you watch through this diagram, you discover that in most of the diagram, there's either a negative sign or a positive sign. We have here 1, 2, 3, 4, 5, 6. So the 6 accounts in question here are the capital account or the equity account, the account receivable or the debtors account, the account payable or the creditors account, which is 3. Then we have the assets account, that is tangible assets account, which makes it 4. Then we have the income account, which makes it 5, and the expenses account, which makes it 6. Each of these accounts either bears positive or negative sign. It's a receiving account, that means it represents debtors. Then we have the account payable. Account payable represents suppliers. You can see it is negative here, meaning it is a giving account, it gives out. Any account that gives out is seen as minus. That means when you are giving out, something is going out. But when you are receiving, something is coming in. So for the account that has negative sign, they represent accounts that usually give out something. Then here we have asset account. It's a receiving account because anytime we spend money to buy assets, it is the asset account that receives such value. So assets are positive. That means they are receiving an account. Then we also have the income account. Sales is an income account. It's a giving account. It's credit account. It's always having a credit balance. So you can see negative here. Also we have expenses account and we have positive. That means it's a receiving account because it makes us to spend. So any account that causes our organizations to spend money or to give out money, that means that account is a receiving account and it's always what? Credited. You can see expenses makes us to spend, asset makes us to spend, and they receive the value. So that is why you are seeing positive. Sales gives out value. Whenever we sell goods, something is going out from the organization. So it is negative, something goes out. Account payable, suppliers. Suppliers gives out value. You can see it is negative. And account receivable, debtors. We sell goods to them and they have not paid, so they are receivers. So it's positive. Then we have the equity account, which represents the owner of the business. The owner of business usually puts in money into the business or releases money so that the business can start or progress. So it's a giving account, so it has negative. So in respect of these positive and negative accounts, we are going to know more about them when we visit the double entry principle. To open account for all these terms we have mentioned, like equities, account receivable, account payable, assets, income, and expenditure. So if you watch, you discover that we can just open the capital account or equity account by just ruling a cross, and we call it equity, capital, or equity account. You can see the sign. It's on the credit side, which means it's a giving account. It gives out value. Look at the payable account. We have the debit side and the credit side, just like we have the debit side and the credit side here. And the payable account, they represent suppliers that we buy goods from. You can see it's negative on the credit side. It's a giving side. So any account that gives out value is usually credited. But any account that receives something or that makes us to spend money, because when we spend money on that account, it's that account that receives it, is debited. For instance, we have receivable accounts or debtors account. You can see debtors usually receive value from us, and we can see is positive. It's always having a debit balance. So we can also see the sales account, debit and credit side. You can see it has a negative sign showing that it gives out value. It's an account that always gives out value. Then we also have the rent account. Of course, when we pay rent, the money goes out because of rent. So rent is the receiver and rent is debited. You can see it. It always have debit balances. So looking at the rent account, you can see it is debited. So it's positive on the debit side. What it simply means is that anytime we pay rent, it is because of rent that such money is spent. So any account that makes us to spend money is a receiving account and it's usually debited. So you can see this account is debited because it's a receiving account. This account is credited because it's a giving account. We have also been able to tell you about accounts that receives and accounts that pays out. Usually accounts that receives are debited, while the accounts that gives out value are credited. In order to know which account is to be debited and which account is to be credited, and when to credit a particular account and when to debit a particular account, we must have full knowledge of the double entry principle or the principles of double entry. Now, what is principles of double entry, or what is double entry principles? Classified. What is double entry principles? Double entry principles states that for every debit entry, there must be a corresponding credit entry. And that for every credit entry, there must be a corresponding debit entry. As you can see, the account has two sides, the debit side and the credit side. What the double entry principle is telling us is that an account can be receiving or be giving out. As a human being, sometimes you receive values and sometimes you give out values. So when an account is to be opened for you or for anything, it has to have two sides, the debit and the credit. One side representing the receiving side, while the other side represents the giving side. Accordingly, any account that is receiving value should be debited, and when an account is giving out value, it should be credited. An account can receive value today and tomorrow gives out. No wonder it has two sides, so that when it receives any value, it is debited, and when it gives out value, it will be credited. However, this does not apply to all accounts. There are some accounts that credit represents their giving out, and some accounts credit represents their receiving. So by the time we go into the principle of double entry and also take some illustration, you come to a better understanding of the double entry principle and how they relate to our postings and calculations. So let us have a look at what the double entry principle is all about.